Hello, and thanks for joining us. I'm Shannon Sand, an agricultural economist and extension educator with the University of Nebraska-Lincoln Center for Ag Profitability, and one of the hosts of Ag Smart Money Week. CAP hosts regular webinars most Thursdays at noon Central Time. You can find the schedule of upcoming webinars as well as the archive of every recording on our center's website, cap.unl.edu. Today, we are joined by Justin Trompke from AgWest Commodities. He's going to be speaking to us about how building a marketing plan and how building a marketing plan can help mitigate some of the risks associated with market volatility. To present, we are very excited to have Justin with us. He is the CEO, broker, and cash advisor for AgWest Commodities. Justin, thank you for joining us.
Thank you, Shannon, and thank you everybody for joining here. Thank you to UNL for putting this on. Truly is an honor to be able to speak to all of you here today. So we'll kind of get started here. For those of you who don't know AgWest Commodities, we're a commodity brokerage firm based in Holdridge, Nebraska. We've got 10 offices across 4 states, as you can see from the map here, stretching from the Front Range of Colorado clear to the Mississippi River. So we assist about 2,500 plus customers across our trade territory and expanding every year, hopefully. So kind of wanted to go through the agenda here. One, we want to define the problem in marketing. Why is marketing so tough? And then we've come up with what they said of top 10 rules to make someone a better marketer. You don't have to follow every single one of those, but if someone just takes 1 or 2 things away from this, you probably will be a better marketer. So we'll go through building a plan and executing that plan, some tips and tricks on things you can do to squeeze every penny out of the market. So we do have a risk disclosure document that we have to present in every one of these that we do. So there's risk in trading futures. You can lose more than you put in, obviously. So you can read that and we'll move on. So defining the problem in marketing. Why is marketing so tough? Well, markets do what they've always done. They go up and then they go down. And this happens year in, year out, really without fail. I mean, there's some exceptions where markets go up and then keep going up, but eventually they do make a correction, and that's just the way the markets work. We looked at this is one of the major grain buyers out there. About 80% of the grain in a given year is marketed in the bottom third of the market. So not a real great statistic when you look at that. And then percent of producers that market with a structured plan. If anybody guessed less than 15, that is correct. So again, not a great set of statistics when it comes to marketing with less than 15% marketing from a structured plan and 80% being in the bottom third of the market. We feel that there's a pretty major correlation between those two. And they're closely related, why guys tend to struggle. So why is marketing so difficult? Well, emotions can really just mess up someone's head, right? You've heard FOMO, and a new one I heard the other day was FOBO. So FOMO is just a fear of missing out on a better opportunity, and FOBO is fear of a better opportunity out there. Really one and the same, but it's emotions, right? Guys want to sell grain at the top of the market, and they think that if they don't hit the high, that they're missing something. So we try and ease those emotions in our plans that we put together for guys. A lot of people just have a limited understanding of the marketing tools out there, how to use futures, how to use options, and a paralysis by analysis is another thing. You hear news on the radio. You see tweets every day, what's going on in South America, in China. You turn on the news stories and you hear this, and you just kind of get overrun with news, and you just don't know which way to go. So that's the whole paralysis by analysis. And then pride kind of gets in the way for asking for some help, which kind of befuddles us a little bit, just because guys aren't experts on everything. Farmers have to wear so many hats, and comfortable hiring an agronomist to help them check for bugs and moisture sensing and things like that. But when it comes to financial decisions where money's involved, they just have a tough time reaching out for help on something like that. So we've come up with these top 10 marketing rules that we can follow, and kind of breaking them down. Rule number 1, no one knows where these markets are headed. Consistent profitability needs to be everybody's primary goal in marketing. And no one can really consistently hit the top of the market. So if anybody tells you that they can, I would suggest don't walk away. I would run away, because it's just not very possible. If there's someone out there who does that, I'm sure they're not telling anybody else, because they don't want anybody to know their secret. So we like to sit down and go through a cost of production, get an accurate cost of production based on what your APH yields are. Well, how do we do that? Well, you turn to the University of Nebraska Extension, right? So they put out their custom rates, and we utilize these a lot for planting operations, tillage operations, harvest operations. It makes it easier to go through and get an accurate cost of production without going into it with a fine-tooth comb. If you go look at the planting operation there, and you can see, ridge planting with band applicator, $25 an acre is the most common. You put that in, that should figure out your insurance, all your equipment costs and things like that, so you don't have to break that out and be so specific. It helps just speed up the process, and that's where guys get bogged down, is they just don't like spending a lot of time digging through all those numbers. So this really helps kind of speed that up and still come up with an accurate number. There's 1,000 of these out there. We've got our own that we've built as far as a cost of production number out there. And kind of read from the top down, and I'm just using a South Central irrigated farm here, and this is just a sample plan. There are some pretty accurate numbers what I think cost of production is this year, but the acres and the APH, it would be pretty close. So 1,000 acre guy who has a 240 yield, seed for this next year probably going to be around that $130 per acre. And you can read down planning at 25, irrigation, that's not a known yet, but we can estimate that at $75 pretty comfortably. Crop management, that's your crop scout and any marketing service, things like that. Insurance at $100 an acre. Well, that's crop insurance, that's hail, that's wind. And then I like to put, since I'm in irrigated country, pivot insurance, vehicle insurance, farm insurance, your umbrella policy, things like that. So, don't take these numbers to heart, because these may not be exactly what your operation looks like, but kind of using some generalities here. Harvest and trucking, again, that's a custom rate. Cash rent, $300. That, you know, we could probably argue that the rest of the day on what cash rent is and what it should be. Drying, if you throw in some drying charges, if you're binning some corn, electricity, gas, things like that. Other category, $25, just kind of covers all those miscellaneous repairs and things like that that you don't think of through the year. Tillage, fertilizer, chemical, insecticide. And so it kind of puts a total down at the bottom, and then ours kind of gets it into a nice little pie chart so you can analyze what's my biggest expense. Fertilizer obviously is a big one. Cash rent's a big one, along with seed. The other ones are more minor. So this example, $1,093 or $1,093,400. And then you can break that out into fertilizer by operation. You can do chemical by operation, put in your application cost. Just threw some numbers in here is pretty general numbers. We've got a nice section for notes on there, so you keep track of what you meant when you put that number in there. At the very bottom, we've got interest on operating. Put 8% for 4 months, and that calculates back up on this back one. On the bottom there, $28.40 an acre just on interest. That's where you get that number from. And then ours kind of has a pretty cool profitability tool on the bottom. I'll note on the top here, you can break out your land costs between interest and taxes and equipment depreciation and insurance, things like that. Keep in mind, we just put in the custom rates from the NEP guide. But living expenses at $50 an acre should be included in there. And honestly, $50 might be a little bit light. But we've got this nice profitability tool where you can plug in some what if scenarios. At $5 corn, it takes 229 bushels to break even. We can plug in some yield potentials. We can plug in some price potentials on the bottom. We'll throw in there 250 bushels an acre at $5 cash, and that spits out a 9.32% ROI at that $1,093 an acre. So again, this is what our program is. There's hundreds and hundreds of these out there. You can put this on an Excel spreadsheet and do it yourself. Put it on the back of a napkin. It doesn't matter, but just go through the exercise of doing this is a good thing to be doing. Big picture analysis it really does lay the foundation of a marketing plan. And what I mean by that is don't get too caught up in the day-to-day market moves. If corn's up 2 today, why? Well, it doesn't really matter. Let's take a look at the big picture. I'll illustrate that with the cattle market right now. We're due for a 10-year mid-decade cycle low. Any year that ends in 6 is kind of a low in the cattle market. So naturally, we're kind of looking at 2026 for a low to be due in the cattle market. But that's beside the point. Look at this chart. Are we closer to a bottom or a top? And answer is we're certainly closer to a top. Now, are we at the top? I have no idea, but it sure looks like historically we shouldn't be getting really too bullish the cattle market right now. We probably should be thinking more, how do I protect these prices? How do I sell it at these levels? So if this thing does go down, I'm going to be here to farm another year. We like to determine potential price risk for each marketing period. So I'll kind of look at DEES 24 corn chart. And I blew this back up to 2007 when ethanol came about. So you can see the high in 2008. You can see the drought years in 2011 and 2012. But I want you to focus on the 2009 and 10, and then from 2015 to 2021. There was a long, just sideways trading range through those periods of time. And when you look at this chart, we all hope that corn stays above $5 this next year, but so far we've kind of broken below that. The next level would be 450, and that's the top side of that long-term range that we saw. Hopefully that provides some support, and hopefully we get into a range now of 450 being a low and maybe $6 being a high. But we have to be realistic when we look at this and see back in those times what things were, stocks to use ratios and things like that. So basically, if we break below 450, there's a risk down to 320, believe it or not, this next year. So take a look at the big picture and note those points so you can better manage, how do I react if the market does break below a certain point? Where could we go? Things like that. So you always want to look at big picture. We got to establish realistic financial goals and develop a marketing plan that really meets those goals. I'll take John Deere, for example. This is from 2010 to 2020, their net income. And on the very bottom, their return on their investment has been anywhere from, looks like, just below 5% to me, up to maybe 15 to 20%. So if John Deere is making 15 to 20%, and we as farmers out there are setting goals at 50 and 100% return on investment, yes, there has been opportunities for that the last couple of years, and back into the drought years and things like that if things go crazy. But realistically, we probably shouldn't be setting our sights on those kind of expectations. So if John Deere is happy with a 15% return on investment, think that way, think more business minded, and you probably do a better job. Number 6, discipline is extremely necessary for successful marketing. Emotions come from all different directions, and emotional decisions typically lead to pretty poor decisions out there. So try and stay disciplined, come up with a plan, and stick to it as best you can. Futures and basis price should really seldom be set at the same time. And what I'm kind of getting at there is futures and basis really have a different seasonal pattern. When futures is really good, basis usually is not. Futures is kind of the big picture, world supply demand, and basis is more kind of a local picture, what the weather was that year in that particular area. Do we need to bring corn into that area because of problems? Do we need to always bring corn into that area? You look at Southwest Kansas, they're usually a positive basis. You look at Central Nebraska, we're usually a negative basis. It's because we grow a lot of corn in Central Nebraska, and Southwest Kansas just doesn't grow as much. So there's different basis levels for different areas based on that local supply demand, and then freight to get it to those places as well. So we always say you want to separate those decisions because when futures are good, basis usually is not, and vice versa. So basically a flat price marketer, we try and stay away from that mentality. Number 8, we like to maintain ownership and flexibility to choose a buyer. So basically we're talking about hedging with futures here, or hedge derives. So there's 2 price environments a marketer can do. The cash market, you can either make a cash sale to an elevator, you can write a hedge derived contract with them, you can write a basis contract, you can sell out in time forward this year and the year ahead. And there's some other hybrid contracts that you can do, but that's all done with a buyer, an elevator, a feed yard, a ethanol plant, what your buyer of your choice. The futures market, we're talking short futures hedges. We're talking put options and call options to manage price risk. You're kind of doing the same thing. It's a little different, but you're trying to mitigate risk is what you're trying to do on both sides of things. Advantages of the cash market, you're mitigating your price risk. If you sell corn and corn goes down, you've got that price locked in no matter what. The buyer assumes the margin exposure on it. You sell to buyer of your choice, and that's that. They'll take the margin risk. They're usually putting a hedge on themselves but that does nothing to do with you. Disadvantages: you're locked into that buyer. You no longer have flexibility. If one buyer that's 10 miles down the road gets a better basis, well, you're kind of stuck with that buyer. It's a deliverable contract. If you sell them a contract and they send you a contract to sign, and you're on the hook to deliver. If there's a problem with production, there's ways out of that. But overall, it kind of limits your flexibility in the marketing decisions that you have down the road. Over on the future side of things, the advantage is you're still mitigating your price risk. Now you're not tied to a buyer. You have the ability to shop around for different basis levels down the road. You're not required to deliver to anybody, and you just have a lot more flexibility. Disadvantages of that is you have margin exposure. And some guys, that's kind of a four-letter word. They really don't like margin calls, and therefore they just don't want to mess around with it. And that's perfectly fine. It does require a lot of discipline and understanding of how the system works. So hedge derives and NBEs, you fix your futures price, but you leave your basis open. So HTA, I'll refer to that, and that's just a hedge derive, or some elevators call it a no basis established, or NBE. So I'll go through an example. This last year on June 16th, you could have sold December corn futures at $6, and you would have gone and written a hedge derive with buyer of your choice. They typically would charge you anywhere from 3 to 15 cents as far as a service fee. In this example, I'm going to use 5 cents. So your net futures price is $5.95, and then basis is still open at that point. So come October 20th, corn's ready, get the combine fired up. You're ready to deliver corn to whoever has the best basis. You're ready to deliver to the contract, the elevator that you wrote the contract with. Let's say their basis is now 30 under the Chicago Board of Trade. That's pretty normal this year. So your net sale on that hedged grain was $5.65. Your $5.95 net futures minus your basis, and that's your cash price. So all the way through, the buyer assumed the margin risk, and in exchange for that, they charged you that 5-cent hedge derive fee. Great way to market. We do a lot of those things, and it does work really well. A hedge derive gives you some flexibility down the road. We'll talk a little bit about carry and basis improvement down the road. But it still gives you that flexibility, and that's a good option to have in your back pocket if you've got bin space. Now let's take a look at, I got two examples for a short hedge, one if the market goes down and one if the market goes up. So we'll do the down first. June 16th, you could have sold corn at $6 futures, and then October 20th, you get the combine fired up, ready to go pick the corn. And let's say corn is at $5 at that point. Well, to get out of your position, you got to buy that back, and you buy it back at $5. So you have $1 gain in your hedge account that you've got. That's kind of fun to have that happen. But on the same day, you go sell grain at your local elevator. The same day, the same hour, the same minute. Preferably, you should probably have a conference call with the buyer and your broker at the same time. The minute he puts that cash contract in place, the broker needs to offset that futures position. So you get exactly where your sale is with the buyer is exactly where your offsetting position on the Board of Trade is. That's the best case scenario. You set basis for your harvest delivery at the buyer of your choice at 30 under, and your cash price with the buyer is now $4.70. You've got your $1 hedge gain in your brokerage account. When your in and out is going to be roughly a penny worth of commission. So we're going to say 99 cents you gained net on that. And your net sale on that hedge grain is now $5.69. That's always fun in a $4.70 market to say that you sold $5.69 cash. So basically what happens is the gains in your hedge account offset the lower price at the elevator as you deliver the physical corn. Now we'll switch over and do a not so fun scenario where the market goes higher. So same scenario, June 16th, you sell corn at $6. And October 20th, let's just hypothetically say corn was at $7 here. And so you've got a dollar loss in your hedge account. You've had to pay margin calls along the way. Someone's had to call you and you've had to write a check or do an ACH or something like that to finance that difference. That's the emotional part. Same day, you go and sell grain at your local buyer. So if futures are at $7, you're getting out of your hedge, the buyer is going to sell or be able to write a contract for $7 minus their basis. For this example, let's just say to keep everything consistent, let's say basis is still 30 under. That may be different since the market is up versus down. But $7 cash or $7 contract minus 30-cent basis is $6.70 cash price with the buyer of your choice. You have a dollar hedge loss in your account now, plus your penny commission, so $1.01, and your net sale on that grain is still going to be $5.69. So basically how it works is any gain or any loss that you have in your hedge account is offset by a higher cash price at the elevator. Now, I can't stress this enough. The key to this working is the same time that you offset that futures position, you have to go sell the cash grain to someone. If you get out of your futures position and you don't go sell the cash grain, you think the market's going higher, whatever, you become the biggest speculator in the market at that point. So that's very, very key to do those two offsetting positions at the same time. Sell grain, exit your futures at the same time. So the difference between the three, hedge derived or NBE, was a $5.65 cash, the $6 futures minus the hedge derived fee minus the basis. In all these examples, basis is the same. The short hedge is a little bit better by 4 cents. You have only a penny worth of commissions instead of the 5-cent hedge derived fee. And if the market goes down or the market goes high, as long as you offset that position when you exit your futures position, if you make a cash sale, your net is going to be the same. I don't care if corn goes to $8 corn, $9 corn, or down to $3 corn. Your net should be $5.69 no matter what. So actually, in this example, hedging in the futures is actually better if the margin calls on the scenario where corn goes higher don't get away from you. There's one calculation that we're missing here. If you're financing margin calls with borrowed money, you've got interest cost. So that would be one thing that may add up on a short hedge is the interest cost on that hedge. So your net may be a little bit different given what the actual interest bill was on that margin call if you do have one. So we feel that hedging is a pretty good thing to be doing, but there are pros and cons of it. And there's 3 people that need to understand the whole process. And who those 3 people are is you as a producer, your spouse, and your lender. Lender has to be fully on board with what you're doing. Be upfront and honest with them about the fact that you're hedging. Lines of credit may need to get extended if the market really is moving higher and you're selling into that rallying market. But that's a good thing. As long as you're not done selling, you always want more to sell. You always have more to sell at a higher price if the market's going higher. So now, having said all that, hedging does have its benefits using futures, but there are some people who are just not ready for it. And if you're one of those people, tippy toe into it. Don't go rushing head first or with both feet. If you're not ready, don't fully understand, have a good conversation with your banker, with your broker. Really, get to understand it before you go diving in head first. Okay, so back to the rule number 9. Every good plan does need to include a contingency plan just in case the market changes. Now, we all think that the market's going higher. That's what we hope for. But what if it doesn't? What if it goes lower? What if we have a year like 2013 where the end of December was the high of the year and we did nothing but go down? We had a couple of rallies in there, but they were just more corrections. We didn't have anything that made a new high for the year. So if that were to happen, having some floors in place would be nice to kind of see if the market does turn and want to go higher. In this example, it wouldn't. So, but what I'm talking about is getting some put protection in place. And what a long put does, it gives you the right, but not the obligation to sell futures at a certain strike price. So if you were to buy a $5 put and spend 20 cents on it, you would have the right to be short $5 corn if the market is below it. Now, if the market's above it, you're not obligated, but you have the right to, if corn would be at $4, you'd have the right to exercise that option. So basically what it does, it gives you a safety net. It gives you the ability to be patient, see if the corn market or whatever market you're in is going to go higher, because that's all what we want to have happen. But it's kind of a plan B just in case that market doesn't do what you think it's going to do. You pay a premium to own that right. So that's your risk, is what the premium you paid plus commissions is what your risk is on it. If it goes away worthless, you buy a $5 put for 20 cents. Corn is at $7 in the fall. Great, go sell $7 corn. You paid 20 cents that you didn't need to, but you bought the time to see if that market went to $7 or not. So we always suggest that folks look at puts on unsold production, whether it be all of it or just a portion of it. That's up to you as far as what risk you're willing to take. If you are 100% protected with put options, once you make a sale, you don't need that put anymore. So we would exit out of the put every time you make a sale. And then we have a mechanism, I won't get into it, but trying to manage those puts. If the market goes up, we can roll it to a better put, get a better floor. But the overall puts are just about avoiding disaster. It's a plan B just in case the market doesn't do what you think it's going to do. So how a put works: if the market goes up, the put value decreases, and if the market goes down, the put value increases. And this is how it protects you. If the market is going down, that put will gain value as the market goes down to offset that falling market. As it goes up, you have the ability to sell at a better price, and that put value will decrease, which is all what we want. So number 10 would be, this is probably a really important one. Perfection is undefinable, and they're really unachievable. So don't worry too much about what everybody else is doing, what your neighbor is bragging about at the coffee shop. Set your goals and be your own judge and jury on whether you did a good job or not. And it has nothing to do with hitting the high of the market. It has everything to do with being profitable. And your cost of production is your cost of production. Your neighbors is your neighbors. So don't worry about what John Deere does. Don't worry about what your neighbor does. Work on your plan and know your numbers very thoroughly, so you know what works for your operation. So how to come up with a plan? Well, here's our kind of look at what our plans would look like if you're a customer of ours. Again, there's a lot of software out there. There's several that you can plug all your numbers into. Excel spreadsheet, you can build it. right on the back of a piece of paper, whatever it is, just write down a plan. So kind of put up a mock plan here where we've got a little bit of corn sold and then some targets. So just throwing in some random numbers here. If corn goes up to 550 to 570, probably should be a willing seller. If you would sell 20,000 bushels at a shot, I think that would be a pretty good plan. So now, once you get a plan built, you want to be able to have the option to stress test that plan. We've got a pretty cool calculator on our database that the guys can do that if they're customers of ours. On the left-hand side, it goes through your break even, what percentage you're sold, gives you a nice pie chart of where you are currently. And then over on the right, it has a stress bar where you can move that up and down and stress test your plan. If corn goes up to, in this scenario, I've got 597 in there. It shows down on the chart that I've got one sale made, and then it would theoretically fill those contracts as the market goes higher and kind of tell us what our average is as a whole. You notice the green and the yellow boxes over there. That's a layer of calls put in on the upside, and that's a layer of puts on the downside, and how that would act. So this is all theoretical. You can just get a calculator out and add up what those sales on this last slide would be. If the 531 hits on 20,000 bushels, how many dollars is that? What's the dollars on the 543, the 553, so on and so forth. And you can see how many dollars you'd have. Take that minus your break-even price and figure out your profitability. We've just kind of tried to lump this into one easy, quick way to look at things. Now, we also look at what if the market goes down? As you notice on the pie charts, the yellow is where we have options hedges. The green is where we have bushels actually sold, and the red is what we have unpriced, unhedged. So on the current plan, we're currently nothing in place, but the potential that I'm putting in here, I've plugged in some puts, I've plugged in some calls and those expenses, and I can quickly run up and say, okay, what if we get 2 targets filled, and then the market goes down and down to 427? Well, where we have that yellow box shaded is where those puts would be protecting you if the market did fall. So again, you can do this on your own and run some scenarios of what if corn doesn't do what I think it's going to do and it goes to $4 this year. How is my plan going to look if that scenario plays out? And then once you get that figured out, what am I going to do about it? Do I need to sell more corn now? Do I need to buy more puts now? And again, every plan is going to be different based on the certain risk appetite guys have and what they're willing to do. So that's kind of basics of building a plan, how that would look on our end, and how to stress test that. Now, once you get a plan built, once you get some targets in place, hopefully you have the chance to make those sales. And then what do we do about trying to squeeze every penny out of the market that we can? This is where merchandising 101, managing your basis and carry spreads out there. If you have bin space, this is what the commercial elevators do to make money for their space, and there's no reason you can't do the same thing on your own farm. So I'll go through some examples here. Basically, like I said, that's how the commercials return value to their assets, and you should be doing the same thing on your farm. It's all about trying to return that an ROI on your bin space. So what is the carry spread? It's the difference between one contract month compared to a deferred contract month. A large carry spread, when those numbers are pretty wide, that usually means there's a fairly good sized crop coming. The market does not need all the corn in October, November, so they're willing to pay you to store the corn out till future months when the end users need it. If you have a small carry spread in the market, usually indicates somewhat of a tight crop is expected, and the market participants, end users want to get their hands on as much corn as possible, so they make sure that they don't run out. So we watch these pretty extensively to see what the carry spreads are telling us, whether we should store corn or whether we shouldn't. So I'll go through an example here, and I just took, I think this was yesterday's corn bid. We had December 24 corn at 478. Basis is 30 under the board, so 448 cash is where you're at today. D's 23 at 478 meant March 24 was at 493, and May of 24 was 502, July was 510. So the difference between D's 23 and March 24 is 15 cents. And then you can see March to May is another 9, May to July is another 8. So you got 3 months from D's to March, and then 2 months to May, 2 months to July. That's why those spreads look a little bit different there. But so let's just take an example. If we were to put corn in the bins and avoid selling that 30 under basis at harvest time, how would that look? You take your December 23 futures, whether that's a hedge derived with an elevator, or whether that's with a broker, just a short hedge on the board, and you roll your contract to the March of 24. Just means that you're buying back the one you have and you're selling the one that further out in time. You earn that carry spread. So 478 plus 15 cents, you're now 493 off the March board. And you could just go sell that corn at 493 to start out with too. That'd be a possibility on this scenario. What's basis going to be next February? Well, nobody knows for sure, but I would venture a guess it's going to be better than what harvest basis was this year. I'm just going to use a 10 under example. So 483 cash, it'd be your 493 minus your 10-cent basis. So what did you return to your bin space? About 35 cents. 448 at harvest versus 483 in February, 35 cents return on your investment. Now, it's not free to store corn. Obviously, you've got cost of the bin, you've got your in and out charge, you've got interest on that money, electricity, all that stuff. But 35 cents for holding corn for 3 months is a pretty darn good return on investment. Sometimes it's better, sometimes it's not. But that's kind of how we look at it from a returning money to your bin space. So leading into harvest, those future spreads do provide a pretty good insight to what's going on. It gives you the ability to kind of analyze whether you want to deliver corn at harvest time or whether you want to put that corn into a bin. Some years putting corn into the bin is the best thing to do, and there's years where probably shouldn't, rent the bins out and just deliver it all at harvest time. So watch those carry spreads, and the market tells you kind of what kind of a crop is coming on. So unfortunately, for the bullish hat that I want to put on, we've got some pretty wide carry spreads, and what I say with the large carry spread, it usually means there's a big crop coming. So unfortunately, that seems to be the case this year. So prices are reflecting that. And then which crop to bin? If you're a multi-crop producer, do you put corn in the bins versus wheat or beans? Kind of let that make your decisions. So yeah, does your farm storage make you money right now? Well, the only way that you can capture those carries is to fix a futures price. If you're just putting corn unhedged into a grain bin, you're a speculator, basically. You're hoping the markets help you out. You're hoping for a rally, and you're not managing those. You don't have the known, I guess, with the carry spreads of what your return on investment is. You're just kind of throwing darts at the wall. So fixing that futures price is a pretty impactful brick in your marketing wall, so to speak. And it's not all this stuff that we've shared with you here today. It's really, really not rocket science. If you struggle with it, reach out with any questions. Talk to a professional about it, how to do these things. But basically, when it's all said and done, it really truly is about just doing all the little things right. Put this brick in the wall. Set your futures first and keep that separate from basis. When basis is good, set your basis. If the carry spreads are out there and you have bid space, you can roll that price forward and wait for basis to get better, and so on and so forth. And we always put things into baseball terms, and we're not all about trying to hit home runs, but if you're hitting singles and doubles, and that's doing the right thing, locking these things in kind of one at a time, it really does turn into a pretty good marketing plan when it's all said and done. So with that, I will leave you with this. Another thing that is not on the top 10 is you need to make a decision. You need to be decisive, right or wrong. There's things that come up in life, and you've just got to make a decision which way to go, and marketing is one of them. So try and get a plan put together, try and stick to that plan, be decisive, tune out the noise as much as you can, focus on your own profits and not what your neighbors are doing, and you'll be a better marketer. So with that, that's all I've got. That's my contact information. And I think at this point, we're open up to questions.
Okay, well, till we get a couple, I have a question for you, Justin. I know earlier in your presentation, you talked about break even and had some slides on that. So I know you talked about APH being important to that. And I can't recall if you talked about this or not, but what if someone doesn't have a APH available? Maybe it's new ground, or it's just ground they've started renting, and for whatever reason, the previous owner doesn't have that. What are some options to look at?
Yeah, so each county has their own T yield. So for a new farmer, you just have to take the county T yield, which is established just over time. Your insurance provider would be able to help you out with that, what that number is. New farmer programs, I believe you can accelerate that. Your first year goes towards your APH a lot quicker. Your APH is basically your 10-year history, which for a new farmer, that just isn't an option. So for a while on some new ground, you just got to take the county T yields.
Okay. Sounds good. And then we had a couple of people asking if you would be able to share the slides presented.
Yeah. Yep. Reese will go ahead and get these out in a format that we can send out to everybody who wants it, and that'd be great.
Sounds good. Sounds good. And then we have another question. It says, great session. You talked about direct input costs, how producers consider indirect costs, such as equipment repairs, or how do producers consider indirect costs, such as equipment repairs or various other costs that are inevitable? And is there any baseline as to what these costs are at a reasonable versus an excessive price? There's a couple of questions in this one.
Yeah. That's a hard one. The equipment cost is an ever moving number. You saw John Deere's ROI numbers, so they're obviously not making any less money, and therefore tractors are cheaper. I farm myself, and we just traded combines, so I feel the pain on that when everybody is talking about equipment costs. Just trying to be in front of it with what costs are going to be. Budget for that depreciation. If you're buying new, or if you're making payments on it, obviously your payments are going to be your costs that year. If there's a warranty, then you don't have to worry about repairs, but repairs come into it. If you're buying older equipment, you just have to budget that. So That's why I typically like to use that UNL NEB guide. Iowa
Yeah.
State puts one out. Some others put some good information out as well to keep current with those custom rates. You know, if you're using a custom rate, that's a guy going out and putting a man in the tractor, um, insuring it, putting fuel in it, and covering all those costs and making a
Yeah,
profit.
wear and tear on the vehicle or the equipment item itself. Yeah.
Yeah, so those custom rates are kind of a catch-all, pretty close, I guess. You know, if you can't do it cheaper than custom farming it out, then probably look at custom farming it out.
Yeah. Sounds good. Okay, we have another one. So someone recently purchased a 62-cent basis contract for soybeans based on January prices. Um, they think this may have been a bad move since this is their first time. Do you have any suggestions?
Once basis is locked in, you're kind of stuck with that basis. In the carry market that we're in right now, if you roll a basis contract forward, you actually lose the carry in the carry spread. It works the opposite. If you get your futures price, you gain the carry. A basis contract will lose the carry. So rip the band-aid off, deliver that corn as the per the contract specs or soybeans, and move on. There's just
Yeah.
no better way to say it.
Okay. Thank you.
Yeah. I would say hopefully that's not all the bushels that they had, and now the basis is better. And you got more to sell at a better number.
Yeah. Yeah. I think it's one of those things. It's hard when you're starting out to figure everything out. So you're going to make some mistakes. So
Yeah,
kind of give yourself some grace.
yeah, definitely.
I'm not seeing any other questions coming in, Justin. Do you have any other final remarks you want to add or anything like that?
No, I don't think so. I mean, if anybody has any questions, feel free to reach out. Be glad to help anybody with anything they have.
Yes. Yes, a recording of this will be available. It should be posted, I think, in the next 24 hours on the cap.unl.edu website. So you can check that out there. So yeah, because I also want to say I was like, this is a lot of information, which we appreciate you giving us, Justin. But I was like, I know at least for me, sometimes it takes a little while to take everything in, and sometimes I need to go back and double check things. So
Yep, it does.
yes, that's absolutely okay if you need to go back and double check things, because I myself sometimes need to go back 2 or 3 times. So to really get a concept down. So yeah. Okay, so I think that's all of our questions. So with that, I'm just going to say thank you, everyone, for joining us today. Thank you, Justin, for joining us and presenting. A recording of this webinar will be provided at cap.unl.edu within the next 24 hours, where you can also register for other upcoming webinars and events that will be happening. And we would also really appreciate your feedback on the brief evaluation that should pop up, I believe, as you close out of Zoom. That helps tell us how today went and inform us of future webinars. Thank you again for joining us, and have a wonderful day.
Thank you.